Money transfer at a low cost. For less than $1 in transfer costs, people have contributed as much as $1 million in stablecoins. Because of their fast processing and low transaction fees, stablecoins like USDC are a perfect alternative for sending money anywhere in the world. The Biden administration now wants new legislation to govern stablecoins, after several laws have been passed to regulate digital money transfers. So, what does this mean for investors? Let's go find out. Welcome back to the channel. This is the one and only Capital Alpha, where we talk about the latest news in cryptocurrency and all you need to know in the world of finance. We're back with another amazing video, so please like the video, subscribe to the channel, and enable alerts to be notified of each new upload. Okay, let's highlight the importance of stablecoins. Stablecoins have the potential to serve a huge unbanked and underbanked population as a digital currency that can be used to make payments all around the world. Stablecoins have the potential to replace traditional currency to promote faster, more secure, easier, and cheaper cross-border payments for everyone, from migrant workers to businesses, making overseas payments to suppliers or employers. According to McKinsey & Company's Global Payment Report 2019, global cross-border payments revenue was predicted to be $230 billion in 2018. Over 250 million people contribute over $500 billion in remittances each year. In 2020, the average cost of transmitting money throughout the world was roughly 7%. By 2030, the World Bank hopes to lower remittance fees to 3%. A bigger cryptocurrency sell-off has struck stablecoins, which increased shortly after the Federal Reserve raised interest rates by half a percentage point. Investors are worried that the U.S. economy could collapse in the near future due to higher interest rates, growing inflation, and supply chain concerns. As economic uncertainty looms, many investors have shifted their portfolios away from riskier assets like stablecoins and other cryptocurrencies. That's a serious matter. What are your thoughts? Well, when things were going well, the Biden administration revealed some new ideas on cryptocurrency, suggesting new legislation to govern stablecoins. So what exactly does this mean? Let's get this out in the light. Treasury Secretary Janet Yellen said of stablecoins in a report by the President's Working Group on Financial Markets that the absence of adequate governance raises dangers to users and the broader cryptocurrency system. The paper goes on to propose specific new regulatory legislation that would effectively put stablecoins under the same regulatory umbrella as banks today. Stablecoins are a kind of cryptocurrency whose value is determined by the value of a government currency such as the US dollar. Whereas Bitcoin and Ethereum fluctuate from day to day, even hour to hour, stablecoins should in theory remain constant, pegged to the value of a dollar. While stablecoins are most commonly used by advanced crypto traders to trade crypto on exchanges, experts believe these type of cryptos have the greatest potential for future use by everyday consumers to purchase goods. This possibility of increased use by more Americans has drawn the interest of federal officials, such as Securities and Exchange Commission (SEC) Chairman Gary Gensler, Federal Reserve Chairman Jerome Powell, and Yellen, among others. Because cryptocurrency is still in its infancy as an asset class, any new regulation has the potential to have a significant impact on investors' portfolios. What is the proposed new crypto regulation? The report effectively proposes that stablecoin issuers be classified as banks, subjecting them to new rules designed to protect those who trade and use stablecoins. The report highlights three specific legislative proposals. The first requirement should be that stablecoin issuers be insured as depository institutions. Second, stablecoin issuers and platforms should be subject to federal oversight and forced to adapt to appropriate risk management standards. Number 3, stablecoin issuers should be forced to comply with commercial entity affiliation restrictions and to promote interoperability among stablecoins. The report acknowledges the potential for future innovation in stablecoins to expand point-of-sale payment options for American consumers, while also emphasizing the need for new regulations. In the report, Yellen stated, "Current oversight is inconsistent and fragmented, with some stablecoins effectively falling outside the regulatory perimeter." While Congress would be required to act on the proposed legislation, the report states that U.S. financial oversight agencies such as the SEC and the Commodity Futures Trading Commission (CFTC) will take action to address concerns as they arise and fall within their respective jurisdictions, even if new legislation is not passed. What does the report mean for crypto investors? There are several reasons why cryptocurrency investors should welcome new regulations and oversight, such as those outlined in the report. Kiana Daniel, an author of Cryptocurrency Investing for Dummies, said, "As much as I like the decentralization and the lack of government involvement, I'm glad that they are paying attention, because unfortunately with cryptocurrency, there are a lot of scams." While the contents of the report released this week are unlikely to cause any immediate changes for crypto investors, it is a good reminder that policymakers are paying attention, and something will definitely be coming soon. The fundamentals of cryptocurrency investing have not changed. The report focused on stablecoins, but experts say investors should stick to the big two cryptocurrencies, Bitcoin and Ethereum. They have a long track record of increasing in value, despite the fact that their prices fluctuate by day and hour. You should also make sure that your cryptocurrency investments do not interfere with other financial priorities, such as emergency savings, debt repayment, and retirement planning. When it comes to crypto, it's always best to follow the rule of not investing more than you can afford to lose, especially in these uncertain times. To circle back to stablecoins, there are some limitations that I think are important to talk about. So, what are those limitations? Let's find out. The first limitation to consider is that fiat-backed stablecoins are centralized, which means that traders must rely on the exchange to ensure that the stablecoins are fully backed by fiat, even if audit results are not released. Second, fiat-backed stablecoins are bounded by fiat currency regulations, which reduces their conversion efficiency. Another limitation is that in a volatile market, a determined enough attacker may be able to depeg an algorithmic stablecoin from their underlying asset, just like what happened recently with Terra Luna UST. See our video on that to learn exactly what happened. Finally, because fiat-backed stablecoins are so closely linked, they will crash if the economy fails. This is true for both commodity-backed and crypto-backed stablecoins. Their worth is determined by the value of their underlying assets. We all know how volatile cryptocurrency prices can be, and crypto-backed stablecoins are more sensitive to price fluctuation than other collateralized stablecoins. Commodity-backed stablecoins are less liquid, which makes them more difficult to redeem. If you want to exchange a stablecoin tied to real estate in another country, you must go through a lengthy and time-consuming process. Although many people believe that stablecoins are a safe place, the impact on cryptocurrencies must also be considered. This is due to the fact that particularly when large whales move down the market, they can secure a significant blow to the price of cryptocurrencies while securing stablecoin. As a result, there's no unambiguous consensus on the existence of stablecoins. So, what is the future for stablecoins? Well, the supply of stablecoins has been increasing at an unprecedented rate in recent months, and the overall volume of stablecoins is expected to increase in the coming months, especially with new players like Libra entering the space. Stablecoins are widely expected to pave the way for cryptocurrencies to enter the mainstream. Furthermore, with a large unbanked and underbanked population worldwide, and people and businesses looking for faster, easier, and cheaper ways to send payments across borders, stablecoins have enormous growth potential. Stablecoins are also creating a new type of market by mutually influencing the blockchain platform, and I believe this trend will continue for some time. Investors are also closely monitoring market trends, and they want to be the frontrunner in terms of blockchain-based fintech expansion and mass adoption of blockchain services. Today, many people are working on developing stablecoins, and this makes us wonder how stablecoins will affect cryptocurrencies in the future, or how stablecoins will expand their use of cryptocurrency. We probably won't have to wait much longer to see the changes, so let's keep our eyes and ears open until we see the future. So, what do you think about this upcoming legislation on stablecoins? Will stablecoins work in a better way? Leave your comments below and tell us what are your thoughts on these upcoming regulations. That concludes today's video. I hope you like it. Please don't forget to subscribe to the channel and enable alerts to be notified of new uploads. This is the one and only Capital Alpha, and we'll see you in our next video. Bye!